This week was a crushing week in the market, and it's human nature to ask what's behind the decline. We can speculate about the bursting of an everything bubble fueled by debt from quantitative easing. We can speculate about a global growth slowdown and recession. Or we can ask about the message of price. The key to trading difficult markets is to stay aligned with the probabilities communicated in price. And for us, this means continued reduction in risk and shifting to defensive assets as the probability of favorable outcomes deteriorates. It also means being watchful for signs of a bottom and being tactical when we see potential signs of a reversal. This week, we'll review our market bottom checklist, survey the damage on the daily chart, and look at key levels on the weekly chart. This week, we'll change things up a bit and start with our week in review, where we take a look at the headlines and how they move the market. On Monday, stocks continued to fall on global growth fears. On Tuesday, the usual market rally before a Fed decision fell flat. On Wednesday, the Fed decision was widely expected, but the tone of the press conference sank stocks. On Thursday, markets continued their sharp decline, sending a clear message that the Fed was out of step with economic conditions and financial stress. On Friday, the market initially attempted a rally on an attempt by the Fed's John Williams to calm markets, only to test resistance and continue to the downside. The market was down 7.59% for the week, and the month and year-to-date statistics are provided at lower right. Now we'll look at our summary of this week's economic data and interpretation. Week after week, we continue to see a strong labor market, steady gains in GDP, few signs of inflation, and a strong consumer. The fact that there are so few signs of inflation conflicts with the Fed's hike, which, coupled with concerns over high-yield corporate debt and the yield curve, caused consternation in the markets. Overall, the hard economic data reflects a slowing but strong economy, with growth above the trend of the last 10 years. But the soft data, particularly business sentiment, reflects a gloomier outlook. The more flexible stance, indicated by the Fed's John Williams, was positively received at the time of this recording, a little before noon on Friday. The market already seems to be fading the news. Once a month, we also update our dashboard of leading and coincident economic indicators, which uses economic indicators tracked by the Conference Board to create an indicator of the momentum of economic growth. Remember that the stock market is forward-looking and often turns down 6 to 8 months in advance of the economy. Currently, we see the leading economic indicators showing a slight downturn, as does the ratio of the leading economic indicators to the coincident indicators. Looking at the momentum of economic growth, the signal from this indicator occurs when momentum falls below zero. Going back to 1969, as we've shown in previous slides on this dashboard, the indicator typically falls below zero on average 6 months prior to a recession, and you can see that we're still above that level. Since the financial cycle leads the economic cycle, it's quite possible that a bear market could lead to an acceleration in the decline of these metrics, but that would be a prediction. As of yet, we still don't have a signal on this chart. What could turn things around? Markets are very driven by psychology, and a change in sentiment could come from good news on any of the concerns that are overhanging the market, including recognition that slowing growth might mean sustained above average growth versus a deceleration to recession. Earnings season is about to start, and investment managers will start a new quarter in a seasonally strong period. Of course, progress on the trade front and having the Fed out of the way could also boost the markets. Eventually, the market will bottom, and we went over this market bottom checklist last week. We won't review that list here, but we'll keep it in mind as we survey the damage to the S&P on a daily chart. The market declined precipitously through the week and accelerated to the downside after the Fed meeting. We broke below the bottom of the box and also below the February low. During the decline, we tested and failed at overhead levels of resistance, and if the market attempts to stage a rally, we now have to begin viewing each rally skeptically as a potential counter trend and carefully watching for stalling at levels of resistance. As I mentioned last week, you can see that the moving averages have served as resistance. Price stopped several times here at the 100-day moving average shown in pink, forming these peaks. You can look at the other moving averages and see similar points of resistance. So on any rally that might be a potential bottom, what do we need to overcome? Simply looking at where the moving averages end on this chart and looking across shows prior points of support and resistance. First, we need to overcome the February low, which we tested and failed to reclaim. Next is the cluster of lows in late April and early May that provided some report and will now act as resistance, followed by the 10-period moving average, which also roughly aligns with the bottom of the box. Next is a declining 20-period moving average. While overcoming the 20 MA could provide improved tactical opportunities, the key level to overcome for longer-term improvement is the 50-period, followed by being back on the right side of the trend, which would be overcoming the 200-day moving average, and eventually overcoming the 100 MA, which has served as resistance at the last 3 peaks. Following our checklist, we still have our momentum divergence. Sentiment got even more bearish after the Fed meeting, and some are debating if we've seen capitulation. And judging from this chart alone, we haven't found support yet. Risk sectors have deteriorated further, although some of the badly beaten down sectors such as housing and materials have been deteriorating less. We also have yet to see a candlestick with a long lower wick and high volume follow through that could signal a bottom or a counter-trend rally, as we'll see on the next slide. Judging by the daily chart in our checklist, the probabilities favor the downside until we get positive news on one of the overhangs on the market. For markets to bottom, selling pressure has to be relieved. Looking back, we see very high selling volume followed by a high volume follow-through day, which signaled the market was trying to find a bottom. In October, we had another very high volume selling day followed by a high volume day. However, this turned out to be a counter-trend rally. On Thursday, we saw another very high volume selling day, but we can't read much into the volume bar because this chart was created at 10:37 a.m. on Friday, and we haven't closed yet. We're simply saying that in downtrends, we have to be skeptical of rallies that might actually be countertrends. Going back to this white candle, reclaiming the February lows, and making a series of higher highs and higher lows would be a very positive sign. Failure and closing below this level again, followed by a series of lower lows and lower highs, would confirm the downtrend. This chart of the S&P from 2008 shows that high volume reversal candlesticks alone, without the other items on the market bottom checklist, are often the start of counter-trend rallies. We all know that 2008 saw significant drawdowns. If we're only looking at high volume reversal candlesticks, there are many opportunities to try to call a bottom along the way, as you can see here, here, and here. After this last reversal candle, the market would go on to decline by an additional 45% until the bottom in March 2009. We're not showing 2008 to call for a crash. We're simply showing that we have to be wary of countertrends when the probabilities favor additional declines. Again, at the time of this recording, the week is not complete, but this is a weekly chart of the S&P. Price had been in an ascending channel since the low of the 2011 correction. We've now broken below the channel. Looking at price momentum or RSI in the top panel, we had momentum divergences prior to the 2011 correction and a momentum divergence in place prior to the late 2018 correction. RSI has broken below the black dashed center line of 50 and is now testing the prior lows from these corrections. There is a pattern right here on the right side of the chart, which you can see more clearly in this inset, which includes a decline, a consolidation, and a larger decline to the downside than leading into the pattern. Readings from our model are significantly tilted towards defensive asset allocation, and we continue to reduce risk and will continue to make incremental defensive moves until the probabilities become more favorable. As you'll see in the closing quotes, the important takeaway is to use a model-based allocation strategy based on the message of price, and likewise to use a checklist or model-based approach to watch for changes in the message. Before we close, I'd like to wish everyone happy holidays and time well spent with loved ones. I have some travel next week, and the next video will be after the holidays. Until then, I wish you the best. The The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.